Every now and then in the world of finance, a number appears that is so outlandish it forces you to stop and take a closer look. Today, we are going to dissect a financial product that promises a yield on Bitcoin so high it fundamentally challenges our understanding of what an investment should be.
And this is the number that started it all. A brand new exchange-traded fund is advertising an annualized distribution yield of 322.83%. For any of you who are income investors, you know that you're typically looking at single-digit returns. A figure like this isn't just unusual, it is absolutely stunning.
This very question, which was posed online, really gets to the heart of the matter. Is this product some kind of brilliant financial innovation, a new way to squeeze income from a volatile asset? Or is it something else entirely? A dangerously flawed trap designed for the unsuspecting investor? Let's find out. The fund we're talking about is the Tuttle Capital IBIT DTE Covered Call ETF, which trades under the ticker symbol BITK. And you have to admit, its appeal is incredibly powerful. It's like a siren song, perfectly tuned for investors who are desperate for meaningful income in a world of low yields. The marketing here is nothing short of brilliant. First, it piggybacks on the credibility of BlackRock's incredibly popular Bitcoin trust, IBIT. Then, it dangles the promise of weekly income distributions, which is a massive draw for anyone living on their investments. It also offers a simple way to get crypto exposure without the headache of managing digital wallets. But the masterstroke is positioning itself as the solution for investors who are just plain tired of the tiny yields on things like government bonds and blue-chip stocks. Now, to truly grasp the risks here, we have to pop the hood and look at the engine. The source of this incredible yield isn't what you might think. It's generated by a daily, high-stakes options strategy that really requires a closer look. The core of this ETF strategy revolves around something called zero-day-to-expiration options, or zero-DTEs for short. These are not your typical long-term investments. In fact, they are highly speculative bets that expire the very same day they are written. Their entire purpose is to capture large premiums from an asset's daily price swings, which makes them inherently and exceptionally risky. So here's how the fund's daily routine works, broken down into 3 steps. First, it uses derivatives to create a synthetic position that tracks the price of Bitcoin without actually owning it. Second, it turns around and sells those zero-DTE call options against that position every single day. And third, it takes the cash it collected from selling those options and distributes it to the shareholders, labeling it as income. As you might imagine, a mechanism like this doesn't come for free. The relentless chase for such a high yield introduces some very real costs and hidden risks that you won't find in the headline number. And this right here is the fundamental trade-off, the catch. The promise is that you get to benefit from Bitcoin's potential price increase. The reality, however, is that by selling call options every day, your potential gains are severely capped. The promise is high, steady income, but the reality is that this so-called income often comes from the erosion of your own initial investment. This leads us to a crucial concept you need to understand: return of capital. It might sound fine, but what it really means is that the fund is simply handing you back your own money and calling it yield. This is not profit. Every time this happens, the actual underlying value of your investment, its net asset value, takes a permanent hit. If you look beyond the strategy, the fund's basic structure reveals even more red flags. The expense ratio is a steep 0.95% annually. Its total assets under management are tiny, just over $700,000. This means its liquidity is terrible, making it hard to trade without affecting the price. And finally, it's completely non-diversified. All of your risk is concentrated in one of the most volatile asset classes on the planet. You have to understand that a product like this doesn't just appear out of nowhere. It represents a particular business model that is all about one thing: generating fees for Wall Street. In fact, products like this are often called wealth transfer machines, not wealth creation machines. Their primary function, whether intentional or not, is to move money from the pockets of retail investors to the coffers of financial firms. Let's be very clear about who wins in this scenario. The fund issuers, they collect their management fees no matter how the fund performs. The trading desks make money on commissions from the constant daily trading activity. The institutions on the other side of these option trades are positioned to profit as well. And who is left holding all the risk? The retail investor.
So after looking at the marketing, the mechanics, and the money trail, it's time to put it all together and deliver a final verdict on this strategy.
Here is the most important thing to remember. That spectacular 300% yield is not a golden goose laying eggs for you. It is a set of golden handcuffs, locking you into a structure that caps your upside while your initial investment is constantly at risk of withering away.
The analysis from our source material puts it in much starker terms. It suggests that the creators of these products view income-hungry investors not as valued clients, but as a source of revenue to be exploited. So it all comes down to this one question that you have to ask yourself. When you strip away all the jargon and the fancy marketing, this strategy is basically a daily dice roll on the price of Bitcoin. Is that really something you want to bet your nest egg on? Now, I have to be absolutely clear here. This is not financial advice. This analysis is for informational and educational purposes only. You should never, ever trust social media influencers, and that includes this channel, for your investment decisions. It is crucial that you always do your own research. This has been an analysis from Finbot Insights. If you found it valuable, please click the like button and subscribe to the channel for more deep dives into the financial markets. Thank you for watching.